Following a blowout jobs report today that was almost so good it's bad. I mean, 10-year treasury yields are up to 3.97%, up 12 basis points alone today. You're now restricting the economy even more. Tom Lee is out with a new note to clients today and a new interview on CNBC to break this down and try to put markets into perspective. Take a listen.
When it comes to finding overall value right now, our next guest points to October as a seasonally iffy part of the year, expecting investors to buy whatever dip emerges this month because the positive tailwinds into year-end, he says, are stronger than the headwinds. Joining us today is Tom Lee, Fundstrat Global Advisors Managing Partner, a CNBC contributor. Hey, Tom, good to see you.
Hey, Carl, how are you?
I'm good. What do we make of the market in light of the jobs number and a VIX, which I know you're watching, but is still close to 20 today?
Yes. I mean, I think we're in a tricky period because there are these sort of complications, which is geopolitical risk. We've got the port strike out of the way, and I know October has these seasonals. I think it's very good news to see the stock market react positively to a jobs report because it is, in fact, a good report showing the economy is actually not only holding up, but the unemployment rate's down. But I agree with you. The VIX is important to tell us how much we could rally. I know our head of technical strategy, Mark Newton, thinks that we're making intraday lows today, and it's setting up for us to make new highs next week. I mean, to me, that makes sense just because it has been a resilient economy, and then next week we get CPI. But I do think it's hard to say this is a green light into year-end because, as you're pointing out, the VIX is just staying stubbornly high.
Tom, we've seen some changes in the swaps market with regard to expectations for future rate cuts, at least in terms of magnitude. How does that alter the calculus, if at all, for the equity markets? If it is now looking more like a 25 basis point cut in November instead of 50 basis points in those weightings changing, does that impact expectations in the equity market, or that's not really priced in at this point in time?
Well, we know that Fed fund futures and expectations about the magnitude of cuts over the next couple of meetings does affect the bond market. And we're seeing that reaction today. And, of course, I'm even seeing some folks think the Fed made a mistake with 50. But for the stock market, I think what matters more is really the Fed. The Fed is actually in an easing cycle, and we're making our way towards neutral. And so I think that there is going to be times where the stock market, where the S&P is going to rise even if yields are up. I think we're in an instant there because yields can be rising because the economic data is better, and so we're kind of rising for good reasons on yields. And I think that's supportive of stock. So I'm not too bothered if the odds of a 50 have dropped today because of a good jobs report, because I don't think it means the Fed is suddenly backpedaling and back to hiking mode.
On China, Tom, is it good for global growth? But how is it offset, if at all, by any kind of drains to liquidity or just the rush of hot money to either cover shorts over there or try to play along with this?
I think on balance, it's very good news that China's PBOC and the government have launched a bazooka series of measures because it has been, on a relative basis, a drag not only on the global economy, but a huge underperformer for the past 10 years. I don't think U.S. investors are selling their U.S. equities or even small cap stocks to buy China. I think it's coming out of all this cash on the sidelines. We know margin debt hasn't moved for 4 months, and it's still way below the 2021 highs of $936 billion. And we know there's $6 trillion cash on the sidelines. So I think this is motivating money into action, but it's overall, I think, a positive.
Wow, I'm kind of shocked by what Tom Lee said there, at least at the beginning of that clip. He said the VIX being where it is, being so elevated, kind of puts a lid on markets. It kind of suggests more weakening could come to markets. And this jobs report does not necessarily guarantee a green light into year end. And Tom Lee is still expecting some downside in markets. And that's kind of a far contrast from what a lot of people are saying right now. And honestly, I don't agree with Tom Lee here, and I'll explain why. Now, longer term, I think the economy is probably going to surprise to the downside. In the immediate term, I think earnings are the most important catalyst. This jobs report reaffirms the soft landers. And really, if you take the jobs report and the unemployment rate on face value, it supports equity markets. Where I kind of differ from Tom Lee is right now, this year, the election is kind of an afterthought. It's about geopolitical tensions. It's about the energy market. It's about the economy. It's about earnings. I think the last thing the markets are truly concerned with is the election. And I don't think at this point we're going to wake up and say, we're scared about the election, right? I just don't see the election fear out there in markets. Now, historically, yes, there is election fear right before the election, but I would argue in other years, you don't have this uncertainty around the economy. You don't have this uncertainty around the Middle East, but more specifically, uncertainty around the energy markets, whether or not Israel is going to attack Iran's oil capacity. Okay, so as long as the economy holds up, as long as there's no attack on Iran's oil infrastructure, I don't think you have to see this election correction like you normally do. Now, vice versa to that, I don't think you see some kind of explosive rally after the election either if you don't get that election correction. So while a lot of people are saying you want to wait until after the election to deploy capital, I think it's a little bit deeper than that. I think markets just want to be reaffirmed of the state of the economy, which unfortunately, I know a lot of people want things instantly. That instant gratification is appealing. We're not going to get that. Yes, one job report is great. Markets want to see like 3 of them. Okay, one jobs report or one data point does not make a trend, but each trend starts with one data point. Kind of like inflation in the beginning of 2024. It accelerated multiple months in a row, and then Wall Street became concerned about it. It really didn't do much to markets, those first, 1-2 inflation reports. That's kind of the same logic I'm taking with the economic data right now. One good report, really good report, is great. It's great news. I think it's supportive in the near term for markets. And I don't think you need to see that election correction. At the same time, it's not the end all be all. If next week's jobs report or next month's jobs report comes out bad, then we're kind of going to be in the same boat that we were just in, with uncertainty around the economy. If we can string together multiple good jobs reports, then that's when you see more of an explosive rally. And it could be by the end of this year, although my opinion is my opinion, and some people are not going to like this. I don't think the data is very accurate. I see a large disparity between what Main Street is saying, hearing, feeling, and doing, and what Wall Street is seeing, feeling, hearing, and doing, okay? Main Street is reporting it's hard to find a job. Main Street is reporting they're struggling. Main Street is reporting that there's record amounts of people that are 90 days delinquent on their cars. Okay? That's not a great thing. It's not a great sign. Company earnings, not coming in great so far. Darden Restaurants, Nike, Levi's, FedEx was the most shocking. And let me just say this quote again for you guys. FedEx reported earnings the day after the Fed cut rates 50 basis points on September 19th. FedEx reported earnings. Fed cut rates 50 basis points on September 18th. FedEx's CEO said, quote, on the earnings call, which FedEx is often seen as a bellwether company for the economy. If FedEx is doing well, the economy is doing well. If FedEx does not do well, the economy is not doing well. FedEx's CEO said, quote, we seen the size of the Fed's rate cut yesterday. That signifies the weakness in the current environment. I mean, that's all you really need to hear. It's kind of funny because the Fed can lie to you. The government numbers are always kind of iffy. You know who cannot lie to you legally? That is corporations. Because if they do, well, they'll go to prison. It's a big no-no to lie to investors. So I think this earnings season is going to be the most important catalyst really for our markets, because there is kind of uncertainty around just how good is the data that we're getting right now. companies are going to have a much better indication of how the economy is doing. And ultimately, for equity investors, it matters what we get from companies, earnings from companies. And especially right now when markets are damn near priced for perfection. So it's one thing to say the labor market is holding up. It's one thing to say the economy is holding up on this, government data basis. It's another thing to say earnings are coming in good. Earnings are beating expectations. That's really what you need to see to propel this market higher. That's it. It's going to come down to earnings for Q3 and specifically the guidance for 2025. If you do not get good earnings, if you do not get good guidance across the board, which is what we have seen so far from the early reporters, it has been overwhelmingly negative. Nobody's talking about that, but that's the reality of the situation. If we get bad news as far as earnings, that's what can send stocks materially lower. That is also what can spark some wider layoffs as companies see other companies reporting bad earnings and they're like, oh yeah, we're all kind of in this bad boat, potentially bad boat. That's again what it seems like so far with all of these companies reporting good earnings or bad earnings. The only ones reporting good earnings being Micron and Costco was really mixed. Some aspects were bad, some aspects were good. Everyone else has basically been bad though. I mean, that's where you can start to get companies that report that they're going to lay people off. And then you get more companies that report they're going to lay people off. And for that reason, I really think Q3 earnings is the big catalyst of this market. I think you can kind of see via reflected in the markets today, the small move that we got in the S&P is reflective of the soft landing has already been priced in. The labor market coming in better than expected. It's kind of a trade-off because labor market comes in good, less cuts from the Fed. Preferably, you would probably want to see a labor market not at 250,000 jobs, maybe along the lines of expectations, maybe 150,000 jobs. Maybe that supports the Fed going more aggressive, cutting rates, and that ultimately means a lower chance of a recession. The fact of the matter is, the stronger the economy, the less rate cuts we get, the longer the Fed stays restrictive, the higher the odds of a recession are. Now, yes, that means 12 months from now, we could go into a recession because of some of the strength we're seeing today versus if the Fed were to get to neutral as fast as possible, that really lowers the odds of a recession. So yes, this is all new information. We haven't heard much from the Fed. What we did hear from the Fed today kind of showed that they're still on that cutting trajectory, even though it's not going to be 50 basis points for November. They are still looking at cutting rates multiple times this year, at least 25 in November, 25 basis points in December, and then probably going to reevaluate in 2025, see where inflation is at. I don't think inflation's coming back because the economy is on the weaker side. So, I mean, we'll see if this jobs report changes anything as far as what the Fed is going to do. Again, it is definitely making things a little bit more restrictive out in the economy. From September 16th, 2 days before the Fed cut rates 50 basis points, 10-year Treasury yields hit a low of 3.62%. Today, they're up to 3.96%. They're up 30 basis points, little over 30 basis points, 4 basis points from just a couple of weeks ago. That's added quite a bit of restriction to this economy. You can see the RSP today. This is the equal weight S&P is roughly performing in line with the market cap weighted S&P, which is a good sign. The RSP is up 0.52% today. The percent of stocks trading above their 50-day moving average is up to 58.2%. You have about 4.5% of stocks breaking above their 50-day moving average today. CNN's Fear and Greed Index is also moving up today from yesterday being at 67, which was greed, now at 73, which is on the higher end of greed, almost in extreme greed territory. And to Tom Lee's point of what he was saying, the VIX is still sitting at 19.11. You're down 6.73% today, but even though this jobs report came in really good, it did not quell the fears that investors have. I mean, the VIX is now trading at the third highest point you have seen in all of 2024, like for really ever since November of 2023 up until We got the spike to 60 on the VIX recently in August of 2024. I mean, this is the highest you've been in all of this period. There is still a lot of fear out there. And basically what the VIX shows you is the call skew between the puts and calls. So basically, if there's more puts being bought than calls, the VIX goes higher. If the price in which people are willing to pay for puts is higher than calls, meaning more people are willing to pay more for puts to get that protection rather than upside protection versus, the call side, then the VIX also goes up. So this means that people are willing to pay more for puts right now, and there's more puts being bought than calls, which is subjective of maybe some internal fears out there that seems like some on Wall Street don't want to talk about, but they're certainly trying to protect their portfolios to some degree. So again, I think in the near term, this does buy markets some time, but the question really is around earnings season. Starting off next week, you will start to get some of your major banks reporting earnings on Thursday and on Friday. That's going to give us more insight to the consumer. I don't think the bank earnings are going to be bad. I don't think we're going to get super bad earnings from them. So we may have to wait a couple more weeks to get deeper into Q3 earnings season to get a better understanding of, are expectations too high for 20% EPS growth for 2025? I think that's what it really comes down to. And I think that's pretty much price for perfection. That is literally a perfect scenario to give us 20% EPS growth for 2025. Anything less than that, any hiccups, any, further consumer slowdown, and markets are potentially dramatically mispriced. But in the near term, I do think this gives you a little bit of a green light to see some more bullishness and a larger rally. Again, I'm more concerned for November after the election, specifically second half of November, December, January, February, March. If we can get through that period through Q1 of 2025 and things are still okay, roughly like they are today, then you're probably going to get that soft landing after all. Know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. If you have any questions down there as well, feel free to post them. I'll try my best to get back to each and every single one of you. Have a great rest of your day, a great weekend, and I will see you in the next one.